World Investment Forum, who are joining us for this session on sustainability-themed bonds. That covers a wide spectrum of products, from climate bonds to the green bond market, to social bonds, to a blend of social and environmental bonds called sustainability bonds. This is a segment of the market that has seen explosive growth over the last few years, and it holds tremendous potential for funding a lot of the objectives of the Sustainable Development Goals. So without any further ado, I'd like to introduce our moderator today, Mr. Sean Kidney, who is the head of the Climate Bonds Initiative, one of the early pioneers in promoting green bonds and climate-aligned bonds. And we have an excellent panel today. One of the largest exchanges listing green bonds in the world, an issuer of bonds, and some members from the IFC and the UN family who are working and helping to build and grow this market in sometimes difficult circumstances in some countries around the world. So with that, Sean, I'd like to hand the floor to you.
Thank you so much, Anthony. Thank you, everyone, for joining us today. And thank you for our panelists. We have a cool set of panelists. We've got my old friend Julie Becker, CEO of the Luxembourg Stock Exchange, who started off as CEO of the Luxembourg Green Exchange. And I can still remember, Julie, the day that was launched. It's crystal clear in my mind what a road you traveled and how big that has become since then. I want to welcome Alberto Paoli from NL, who has issued stable-linked bonds and has been active in pushing the agenda for transition. And we need to tackle this question of how we transition high carbon companies to low carbon companies as we transition our whole economy. So NL is right in the center of that discussion and that narrative. I want to welcome Jaffa Makano from the UNCDF. I hope I've got Makano right, Jaffa, but I know you'll correct me, who will talk a little bit about what's happening from the UNCDF story. And I want to welcome Denise O'Dara, my old friend from the IFC, who represents an institution which has been really central to the growth of this market. More on that in a little minute. I'm hoping that Kemi Popolo is going to join us from the Nigerian Stock Exchange. And Anthony, tell me if that's not going to happen, because there's a story in Nigeria, a challenging story of getting bonds out the door in difficult circumstances and discovering, to the delight of the government and to the private issuers, that pension funds love them and want more in an economy that is actually a petrostate. And it gives you a sense of this change which is underway all around the world. A few days ago, I was on a panel in Moscow, and the deputy mayor of Moscow said that their green bond they issued recently got a 20 basis points advantage over vanilla bonds out of Moscow. In Moscow, which everyone thought would be very late to the party. This world is changing. Of course, there's a real problem we're still wrestling with here. Let's not underplay this. You'll hear more about this today in other sessions, but we do have well, I can only say a terrifying challenge ahead of us. According to the Intergovernmental Panel on Climate Change, if we don't get global emissions down by 55% by 2030, let me give it to you plainly, we're toast. We have an extremely catastrophic future awaiting us this century. We have already lost the fight against climate change. We are going to see 2 degrees Celsius warming this century. We're trying to get it back down to 1.5 by the time we're finished. But we have to see, which means we do have a century of volatility, of extreme weather incidences, which are going to buffet our societies, and more pandemics, which are rooted in the destruction of biodiversity. So we've got really serious challenges ahead of us. We're not doing very well this year. Emissions dropped 8% last year. Good. That's what they're supposed to do every year from now on. They've gone up 16% this year. You can see how hard this is going to be. On the positive side, we kind of know what to do. Alberto will probably talk a little bit about that from NL's perspective. We have the capital. It's floating around the world, sloshing around in the banks of London and Berlin and Tokyo and New York. And a lot of it is in negative interest rate bonds in Germany and Sweden and Switzerland, and of course in Japan. So that capital can be put to work if we can get our action right. That's good news. We also have a few bits of green shoots, good news this year. The green and sustainable bond market, as Anthony said, is about 2.5 trillion outstanding US dollars now. That's a growth from about 3 billion when I started in this game. That is an extraordinary growth in the last decade. Of course, there's a long way to go. The bond market is $100 trillion outstanding, but at least it gives us a proof that investors will invest if we construct the right risk yield opportunities for them that are green, and they will absolutely swamp to green. The subscription rates in green are often twice what they are in vanilla. That's growing 80% this year, that market, by the way. We've seen the growth of central bank engagement. I had a meeting with the people from the NGFS last week. 95 central banks now in the network for greening the financial system, looking at how to address the forward risk of climate change in regulation. That is, and the dialogue is rich, informed, and going places in terms of regulatory steps coming through. Watch this space. The Biden Climate Summit in April was an extraordinary moment. It brought together all the world's major economies, bar India. We're waiting to hear in the next couple of weeks about India, with 2030 targets that were very robust and very strong. So suddenly the sense of the world going to be doing something is palpable, is real. And I can tell you, investors around the world are absolutely now convinced that the future is decided. It will be clean and green. It's really only a question of how quickly we're going to get there. Will we get there fast enough? And then my last point to finish up, the World Energy Outlook by the International Energy Agency last week gave us a wonderful modeling and summary of the two paths before us. Business as usual, going clean and green. And they're saying very clearly in their modeling, clean and green leads to higher GDP, more jobs growth, a better economy, as well as being clean and green. What's not to like? And now we have the economic modeling to show us. So look, this is what's been happening. There's a lot coming through now. I now want to go to our speakers. I want to ask Denise to start us off, because you may not know this, but in 2013, the only green bond issuers that had been around were development banks. The IFC bought out two over the course of the year, 1 billion benchmark size bonds, and the market went crazy. You know, the first one was sold out, well, 2.5 times oversubscribed in the first hour and a half. And private banks, or rather private investors and issuers, suddenly got interested, and that led to the takeoff of this market. Denise, tell us your story and tell us your thoughts on where we are and where we're going.
Thank you very much, Sean. And before I begin, I want to say that, you know, it's 5 a.m. here in Washington, and I'm so pleased because I'm here in very good company and with old friends and some new. But thank you for having me. And so, of course, you're correct in laying out what led to where we are. And we've seen phenomenal growth, as you said, in the green bond space. But I think that over the course of this conversation, I hope that we can unpack what more needs to be done, because yes, there has been progress, but so much more needs to be done. And particularly as we talk about, you know, emerging markets, the role that IFC has played. First and foremost, what I would urge the panelists and yourself to consider is, well, what is it that actually took, what was that tipping point, right, that brought us to even having every single conference we're in nowadays talking about this product? When we look at the growth that we've had, I would say there were a number of things that had to occur for that to happen. So one was the investor base, actually the desire of stakeholders for this to even commence. Now, for us, with that first green bond that you talked about, I remember very clearly the work that we did with some of my former colleagues, Evelyn Hartwig, as you know, etc., doing a lot of investor education ahead of that transaction, right? But of course, being a AAA issuer meant that it was also more palatable for the market. But the test and the proof of the pudding was, of course, the concept being seen and embraced by the market in general, which of course led, as you said, to private sector issuance. But what we did see, and what we continue to see in the other, shall I say, cousins or siblings of the green bonds, social bonds, subsidies, etc., was the take-up initially by financial institutions. But there is always this huge question mark on the real sector, and I hope that we will talk more about that as we go on. You are on mute.
Oh my God, mute the mute button. There must be some way where your brain can say, turn the mute button on. I know everyone knows what I'm talking about here. Let me go to Jaffa. This market has grown enormously. We do have a very large emerging market component of that, but it is dominated by China. It's largely Chinese, which is the second largest green bond market in the world. And during the pandemic, we've seen social and pandemic bonds coming forward. But the growth in other sectors is still challenging, let alone capital markets growth. What are your thoughts on how to grow this or take advantage of this movement that's going on in emerging market, given that 70% of the capex we need to do, the capital investment we need to make between here and 2050, it's got to be in emerging markets to get a clean green outcome. How do we do this?
Thank you, Sean. I also have to have a disclaimer like Denise from New York. This is a 5 o'clock call, but what we are seeing, it's a very interesting thing because it reminds me of how Africa infrastructure in telecoms actually jumped the landline, right? So that's, I think, is the equivalent of what we are seeing, because there's not really that much of bond market going to finance infrastructure. I mean, this is true with few exceptions. I think the Nigerian market, as you've mentioned earlier, the last 10 years has shown that exception. But if you remove South Africa and a bit in Egypt, the rest is really not that much, and even Southeast Asia. But now there's a lot of demand, mostly because of the continent and changes in demography, and especially in Southeast Asia and in Africa. But the demand is coming with this inflection point in time that we need to go green. So what we are seeing is a lot of especially regulatory environments, which we work with, governments and central governments, asking us, yes, we need to issue a bond, but how can we issue a green bond? And is there a price differential between if we had to issue a vanilla bond and a green bond? And we are looking at it now in about 4 or 5 countries, especially at the subnational level. And thank you for the standards out there. Is one of them from your institutions, which has been really helpful to actually put that on the table, and the IFC ones. And we are seeing a lot of changes on that, and especially water. So, but I want to make one particular point. In emerging markets, what we are seeing mostly is adaptation demand. Yes, there is new energy to be developed, and there's a mitigation side of climate, but there's a lot of realization that, as you've said earlier, we've passed this argument of 2 degrees growth in temperatures, and therefore they have to adapt. And I think for me, I'm seeing a lot of that changes. But the future is green bonds in infrastructure. Over to you.
The future, you heard that here first, everyone. The future is green bonds and infrastructure. I want to pick up your point on resilience, though, because given we have, I'm sorry, everyone, lost the first part of the fight against climate change, and we are looking at a world of extreme, well, let's call it severe volatility going forward in many areas, which will impact societies and economies, not just coastal property. It's getting much more than that, everyone. The resilience part of it is really critical, isn't it? Understanding resilience can be, in a way, understood by looking at the UN Sustainable Development Goals. And the argument we certainly make at Climate Bonds is there's a direct mapping between what looks like, what is about resilience across societies and the UN SDGs, to take the education of women. Inequality is a predictor of fragility in societies. The education of women has a direct causal relationship with improved equality in the society, because women get a chance to participate in their economic life, set up businesses, and they're better credit rating, by the way, than men as a rule. So if we educate primary women, we actually get more equality in society on average, and we get better climate resilience. So this business about linking the dots between the US SDGs and the climate aspects is an evolving story. But of course, as you say, this is the biggest issue for emerging markets with development and so on. How do you see from the UN Capital Development Fund the awareness level of this? And I guess, is this going to be big? My hunch is it'll be big, but are governments going to embrace this kind of interlocking set of understanding between resilience and UN SDGs and development to tell the world what they're doing? How are we going on that?
Thank you for that question. So from my side, I hope it's going to be big. It's not there yet, right? Because the translation of SDGs into a specific methodology and standards that then investors can understand and equate value to it, it's right at the beginning. And I think the private equity area is doing a lot of work. Our institution at UNDP, we are coming up with new seals and new SDG frameworks that we're testing. There's few countries that those bonds are coming, but this is right at the beginning. However, the way SDGs are defined, it gives me a lot of comfort that this market will grow, because for the first time, these development goals have targets, right? You can dig deeper and be able to define KPIs in whatever area. In my own area, I'm working in water bonds in West Africa, in a river basin, and we are matching those to climate bonds, right? Because investors already know them, the standards are there, and within that topology, water is already covered. So it makes it easier, but I think it's right at the beginning of things that we're gonna see quite a bit of working on this. SDGs also have defined this idea of clean energy a bit more open. I'm not sure about the carbon transition. I think the private markets will play more there because of generation. But from our side, we are seeing it coming big time.
So, Denise, this is music to our ears, the conversation we've had for a while. Let's pick up that thought a little later, because I know IFC has got a really good perspective on this issue, but I want to go to Julie.
Okay,
because
I do have a few points to add to that, but yes.
Yeah, no, hang on to that, because let's keep our audience waiting. We've got to tease them a little bit to keep them online. Julie, I just want to go to you, because you've been watching this market evolve in a way that you're in a very special position. You launched the Luxembourg Stock Exchange 5 years ago now. Yeah, it was 5 years ago. You're having a 5th anniversary. I don't know. Look, you've had a big party is all I know. But all I know is it's just growing extraordinary. Tell us a little bit about what you've seen, what you see, what the trends are. And I'm also interested to know how you've evolved to keep up with this rapidly growing market as a lesson for our colleagues in other markets.
Yes, indeed, Sean, it was 5 years ago, and you remember it very well, as you said, because you were indeed on stage at this occasion. But so let me maybe give you some figures about what LGX represent today. It's 1,100 green, social, sustainability and sustainability-linked bonds that are displayed on the platform from 210 issues in 44 countries, which altogether raised a total amount of 570 billion euro, at least, for specific green and social projects, but also for sustainable development across the world. And among those issues, of course, we have IFC and NL in particular. Ever since we created this platform, we have adapted and developed the platform to support and foster market development in this field. What we observe is a real and measurable shift to sustainable finance. Remember, it took 12 years to reach the first $1 trillion of cumulative debt issuance. It was in October 2019. And according to Bloomberg estimates, we might reach in 2021 alone $1 trillion of new sustainable debt issuance in a single year. So the pace of change is clearly accelerating, even if we still need to scale finance for the net zero and scale it fast. So what LGX has done is it has evolved a lot over time. As we remember, from 2016, we were a platform for green bond only. 2017, we extended the platform to social and sustainability bonds. Then 2018, we also extended the platform to other kind of financial instruments, ESG, green, and social funds. 2020, it was the sustainability linked bonds that were displayed also on our platform, broadening the scope of sustainable finance instruments for investors. And 2021, and you know it well, we extended the platform to climate-aligned issuers in cooperation with CBI. So, well, lots of developments indeed on the platform, and the trends we're observing, as Denise was mentioning from the beginning, is clearly a fundamental change in investor behavior. The green bond in particular recently were met with overwhelming response from investors. We saw very recently the bond that was listed on our markets yesterday, the 12 billion euro from the European Commission, was 11 times oversubscribed. Their first social bond last year was 13 times oversubscribed. And if I remember well, the Luxembourg sustainability bond as well was at least 10 times oversubscribed as well. So investors clearly want to contribute to positive change through their investments. And this shows that more and more investors really care about the impact of the investment in our society and on our planet. Another trend which is important to underline, I think, and IFC also is very well positioned in this context, is the rise of social and sustainability overall, but really social accelerated during the COVID-19 pandemic. In 2020, we really saw an exponential growth of sustainable bond issuances emerging as the fastest growing segment of the sustainable debt market. And by the way, according to your study on sustainable debt market, the one from CBI, for H1 2021, issuances with social themes quadrupled in volume when you compare it to same period last year. So it's really impressive to see from $37 billion to 146 billion in 2021. So huge acceleration also in social. You mentioned it, the increase in issuance, increasing diversity in issuers, in sectors, in geographies as well, emerging markets more and more positioned as well. What we see also on our exchange is the product innovation, really well underlying the sustainable finance development. So from green bond to social, sustainability linked bond, climate aligned issuers, highlighting really lots of investment opportunities and more investment opportunities in the broader sustainable investment universe, especially because we still lack green projects. And also because I think that green side projects are not enough also for investors. What can I add? The EU itself is, of course, raising to the challenge. And I think the ambitious green agenda of the EU and the regulatory framework, we know all well, supporting this ambition is clearly accelerating the climate transition across Europe and making financing a driving force and a solution to our global challenges. Maybe to end ahead of COP26, we're also observing lots of commitment to net zero, lots of signatures of net zero pledges. All companies are expecting now to provide a credible pathway to net zero, and all sectors need to transition and need to access to capital in this context. So they also need to disclose their sustainability profile.
Perfect segue to our friend Alberto. Alberto, you're the CFO of a major, huge energy player in the globe, but also in the European market, which is relevant to the comments Julie just made about how Europe is shifting and requiring more disclosures and so on. Tell us about your journey, noting for everyone out there that you've issued green bonds and you've issued a sustainability linked bond as a new instrument that we need to talk about today. Tell us about your journey.
Yes, so good morning. So I take 1 minute before only to say that, so I'm working also under another hat, that is the co-chair of CFO task force under the United Nations Global Compact. That is relevant to stress for me one important point, that is finance and financial instruments at service of business strategy of companies. We can so divide the two things. That's why so we are working on the CFO task force for this. So because we have to create and to move economy and finance in a different world. That is not the world we had right now. When you said coal is a problem today, okay? Because emissions are rising, and they are rising mainly because now is, for a strange reason, economically speaking, it's better to use coal than gas. So, sad to say, but if we not create the economical and financial conditions, because all the business will move towards sustainability, not for ethical reasons, because ethical reasons are important, but then, so you see it, when producing with coal is better than gas. Everyone is doing it. So we have to create, to rethink economical and financial aspect, because all the companies in the world will do sustainable choices, because economically speaking, they are good. That's why we decided in 2015 to change completely our business model and to put it into a full sustainable choice. And we made it because I think we are ethical guys, but also because we found this is the best way to do business looking forward, looking at the future. This is increasing our profits. This is putting our long-standing state for this company. That's the very reason. And when we decided to bring together the financial will, the only instruments present in the market was a green bond that time, and we issued green bonds. But after 3.5 billion euros issued, we asked ourselves, what are we doing? This instrument is not linked to our strategy. I have to earmark here and there some investments, some projects, but I'm not in my project. I am in my targets. My whole strategy is sustainable. So there are no instruments already available for me. And we invented one. We invented a sustainable link bond because of this, because instruments were not linked to our strategy. Now we have issued 10 billion euros. We have 50% of our sustainable finance already in. This market is reaching 100 billion. And so we are very satisfied of this. But I want to say that all the instruments are needed to finance such a revolution, because of a revolution we are talking about. It's a revolution of the way we produce and use energy, first to save the world, but it will not stop from this challenge. At the time in which we will redesign the way we produce and use energy, we will redesign our societies. We will redesign the way we do business. We will redesign the sustainable concept. And also, I think the capitalism fundamentals will be changed by this revolution. So we need all the instruments. What we found in this instrument we issued is linked to the strategy of a company, is linked to the target a company has, is linked to the SDGs that are targets and not specific investments on projects, are targets. We have to put an end of hunger, of climate change and others. Second, I'm getting discount versus my normal bond, because if I have to have a financial incentives is exactly this. So I want to have a discount and I'm getting this. Why I'm having a discount? Because I'm working for a more profitable and less risky company. not because I am a good guy. And that's the very point. And then I have not the use of proceeds. They are general purpose bond. So they are very, very linked to everything I do and to finance the transition we need. All this stuff is relevant. It's relevant as the standardization that the ECMA gave us after 1 year, or the ECB that decided to buy these instruments after 1 year and to have them in the purchase program. Why it is important? Because ECB linked the purchase on the taxonomy on one side and the SDGs on the other side. First European institution that made the link between the two main way to look at climate challenge and transition. European view, US or so global view, target and projects. And ECB did it. And I think it's the way we have to follow in the future to have a wide array of instruments and to first push companies to change so the way they look at the business before the way they look at the finance. Finance will follow the business choices.
Great points, Alberto. And it's very interesting to hear that you're getting the discount for your story. For listeners out there, in liquid currencies, we're seeing discounts for sustainability bonds, but also for green bonds and social bonds, which I'm going to say is not based on sentiment. And I think Alberto's points are very important. It's based on these companies performing better, and these instruments are performing better in secondary market as a reflection. In downturns, they hold their value. When bond markets freeze, they stay liquid, and they are a premium product, which is depressing price at primary across the board here, where we have prices covering liquid. This is the fruits of 10 years of work, Denise, at IFC to help grow this particular market. But Alberto, you said a couple other things too, which I think need to be amplified for people. That essentially this idea of capital with purpose is now everywhere. We've established something in the green bond market first, and now these other instruments, that you can actually get good or better returns while addressing sustainability. That it's not actually a cost. And when I started in this game, and more than 10 years ago, everyone was saying green stuff was going to cost me all, right? Need to give me a premium or whatever. And now we have a situation where green investments are seen as lower risk going forward, more likely to be profitable overall, with of course some companies like NL Strategy being a bit of a standout in these areas. And we saw these two extraordinary moments over the last 12 months with switchover of market capitalization. When in the US, the market capitalization of NextEra, which is a largely renewable energy company, with start off more fossil fuel, overtook the capitalization of Exxon, which is not shifting, which is not transitioning in the same way. And of course, in London, we saw the capitalization of BP overtaken by the capitalization of Ørsted. Now things go up and down, but they were still defining moments about the revolution coming through. And I think NL, your position, Alberto, you're positioning yourself absolutely as an organization in transition. Your CEO has been very loud about this, about the path forward, hence your sustainability bond. So it's a very cool story. Can you now see that the investor response has moved beyond a bit of pricing and engagement and easier access to capital? I'm just curious to know your sense of trends in the broader market.
Well, the answer is definitely yes, but so I have only yes. It's so what you were expecting for, but so I say yes, but so I point here and there something. Well, the very point is that so now, while it's easy to say I'm doing I don't know, a wind plant, and that's why I'm issuing a green bond. So you have not to talk about it. So you have not to understand, okay? So it's easy. So, and for an investor, it's easy to say, if someone else will say, my money will go towards that in wind plant, I'm okay. The very point is, you know, that if the companies that is doing the wind plant project is a company that has a coal mine, that is as the business model, you are going to be repaid not by the wind plant you are so financing, but the whole company, so balance sheet. So having said that, it's clear that, but it's easy. At the time in which you have to understand the new business model, so you have to understand it. And it's for a market that is seeking for standardization and quick, is something that you have to do. That's why I think it's relevant that different institutions will come into this and creating the environment. On one side, standardization of the instruments, very, very relevant. Second, affordable target, okay? So when I talk with my colleague in Brazil, saying there is a paper company, he said to me, so what have I to do to issue a sustainable linked bond, reducing the CO2 emissions? I said, well, so you're doing paper. I think it's better that you link a sustainable bond with your own business. That yes, you may reduce emission, but the way you use and the forest and the plant, I think is more linked to your business. So second is to have a very clear link with the business a company is running, and third, certification of the target, 1.5 degrees. Net zero certification, all this stuff have to be certified from someone else that says the trajectory is okay. When you have all this standardization okay, you may so have investors that are more so easier coming to you. I'll give you an example. When we issued the sustainable linked bond, the very first thing, when we met a huge amount of investors, you know what was the main question we got is, because the instrument is that way, so you are getting 25 basis point discount because you say that you are a sustainable company, and I'm gonna get there is a step up if you don't match the target. I am a sustainable investor. What I have to hope for? That you miss the target because am I gonna earn more, or that you match the target because I am a sustainable fund? The problem is that this question is you can't answer this question if you don't get this very point. That is, well, so it's not a problem for you guys, because if I've said that I'm getting this emission or this penetration of renewable, and I'm also saying that for this, I'm getting a more profitable company, a less risky company. So we are talking the same language, risk-profit curve. So I'm giving you more because if I don't match the target, my company will be less profitable and more risky than what I have promised. So it's easy. It's not an ethical reason. It's an economical one. So guys, I'm doing this for this reason, and you can get a step up because it's the clear way I am giving you a company, not the level I have promised. So that's the very point. So we have to bring and to create a framework that is simple, standardized, but inside have this clear link between the things that we want to promote.
So this is a very important departure and growth in this broader market of, I'm going to call it capital with purpose, that, well, I'm going to call it sustainable returns as well as sustainability on the planet. Let's put it that way. Let's go back to resilience for a minute, which is a new frontier, as Jaffa suggested, thinking's getting there. Denise, let's come back to your thoughts, because I know IFC's done so much work on thinking about this. Where's this going to go? What have we got to do?
So first of all, I think it would be remiss of me not to tie some of the running threads through the conversations prior. So I think that, some very key points have been raised. We talked a lot about growth. And I think what does matter is not necessarily, we celebrate the growth in terms of issuance that we've seen of these products, but is what changes it actually making, what additionality. And that is what, a lot of critics of the market have actually put as their first bullet point when they discuss this. I want to say that what Alberto talked about is quite important, that fundamentally what we need to occur is that business models need to change, right? So, and this of course goes to, there's an article in the FT yesterday that, listed companies alone, we're on a 3-degree trajectory, which is scary, of course, and I need not paint what the future looks like for that. But I think the divorce between finance and these business model decisions in ESG, as we now call it, was quite wide. And this has been one of the benefits of this product, which began with the green bonds, was actually having this conversation. And many moons ago, banks lent money just based on a man with a bowler hat and a stick that looked like he could afford to pay back, right? And things have changed a lot. But what I think the market players here, when you take, obviously, finance is needed, the real industry, which is where the change needs to occur, and policy. So these three players need to come together in a marriage for things to occur. Now, bringing it back to, we mentioned investors, this is the critical point, because we did say this is in fact how things began. And Alberto talked about, the work that they did with the SLBs. But investors need frameworks. They need evaluations. And of course, in the end, they themselves have benchmarks that they need to go by. So what is critical here has been, of course, some of the frameworks that we've seen, obviously the green bond principles played a huge role in this. We talked a lot now about sustainability bond issuance. Julie gave some numbers as well. This year, we've seen about almost 80 billion, if not more. And that's, from last year's 6 billion. What is that fact? To me, I do think that when you see the trajectory, according to when those principles were put out, that you see the effect. There's a correlation there. And that's because investors can now buy a product and evaluate it against something. There is a benchmark, a framework by which they can make such evaluations. The infrastructure that needs to exist, stock exchanges, indices, all need some form of guidance in that sense. But fundamentally, the product in itself, yes, we talk about the feedback from investors. I've heard a lot of investors say, I do not want to be compensated when sustainability targets are not met. It is completely incongruous to what it is that I'm going for. But those are the sophisticated investors. So what actually does need to be done is, again, the mass education, to my mind, of the investor base, but making sure that the incentives are aligned. So I think that's pretty critical, whether we're talking about adaptation, resilience, etc. I just wanted to point that out first. And then maybe if you wanted me to, I can go into your question as you posed it.
No, very good point, Denise. So, Jaffa, given Denise's comments, I'm now conscious about how does this actually work, given the state of capital markets and issuance in the markets you're dealing with? Is it a bridge too far, or is this going to be just happening in the developed capital markets? Or can we bring, say, sovereign issuance into this story in a bigger way? Or what's it look like? What does the future look like?
From what we are seeing, I think, especially from the emerging markets, if you remove the big players, the China and Brazil, we are seeing the beginning of the inquiry. So, for example, the whole Bangladeshi stock exchange was in the US in the summer, and visiting the New York Stock Exchange and having a discussion with a lot of asset managers on this one. We know the transition that the Johannesburg Stock Exchange that is doing to green and sustainability frameworks that then issuers can be able to do it. We've engaged with them quite a bit. We are talking currently with BVRM on the West Africa side, especially to see how that green issuances can work on that side. And there's a lot of support. There's a lot of support on the developing, on the development sector. Again, IFC is leading the way with quite a few frameworks and measurements and certifications guidances. But what is changing is the regulators and the governments are at the same place where the companies are as the companies are trying to figure out the business model. The regulators are trying to figure out what type of infrastructure and how, right? I think now the market have signaled from the investor side that there is a market here, there is interest and there is appetite to buy. But majority of the developing countries' infrastructure is yet to be built. And this, to me, this is a major story from the infrastructure side. Yes, there's a net zero pledge, but how do we do that, right? Is this the same technology we are looking at? Is this the same way of construction and materials and deployment? Even designs. Are we talking a seawall? Are we talking a mangrove way of dealing with it? I was looking at a really good innovative one Canberra is doing. I think HSBC is supporting that one. So there's a lot of also new public infrastructure deployment models that are coming in. And I think that will also make a huge difference because the valuations now will have to change. What is the value of a mangrove forest versus a seawall? We had the city of Miami asking us to support in the discussion there. These are the areas we didn't even think that we'll get a call from, right? But I think everybody is at this point now. And for me, the biggest change is that there's a new thought of how to do these things, and not only just for developing countries, but globally. Over to you, Sean.
I mean, that's the exciting part of the story, isn't it? Is that there's a sense of possibility now that much more so than there was a couple of years ago, but we've still got a lot of architectural work to do. We've got to design. Julie, you sit at the intersection of the European market and other markets, and you have all of these developing relationships and exchanges around the world. But you've also been central to the design of the European regulatory steps for you and I through various expert committees for the past few years. Give us a sense of how you see that playing out, that relationship between capital flows to other markets and also capital flows within Europe. You know, we've got a lot of places in Europe that need more capital. We need to grow massive renewables in Southern Europe. We need to bring Eastern Europe up to scratch and so on. And tell us a bit about the European Commission's appetite to tackle these issues.
Thank you, Sean. Several things to say here. I think that, of course, exchanges have a key role to play as a meeting place between investors and issuers from everywhere in the world to redirect capital flows in the right direction. But what is clearly missing, and what we heard today in the discussion, is that we are, the main challenges in mainstreaming sustainable finance are the famous 3Ds I like, that were reminded by the authority in Singapore: data, definitions, and disclosure. And I think that the solution are 3C, or not the solution, but what we need to solve, which are convergence, coherence, and cooperation. So transparency is key, but also convergence of language, harmonization of standards, and reporting. Because reports, as it was said also this morning, should really allow investors to understand the impact of their investments and put them in a position to compare different reports. So it's not only about what we are talking about, the language we are adopting, but also the metrics and how it is reported in the market and disclosed. You mentioned the European Commission. What they're doing currently is through the International Platform on Sustainable Finance, for instance, and the working group, which is co-chaired by EU and China. And I'm very much looking forward to see this common ground taxonomy being released, because this is, for me, fundamental for investors to be able to compare one investment to another, especially for European investors who have to report on a mandatory basis based on SFDR. And of course, we need to ensure that they will also invest in emerging countries where potentially this taxonomy is, or the EU taxonomy is, of course, not applicable. So universal standards for disclosures and reporting are clearly needed. And the main challenge is that we have plenty of them. There's really multiple and diverse sustainability frameworks today. We have sustainability standards for companies like the GRI, SASB, IRSC. We have sustainability reporting for investors, for instance, the reporting under UNPRI. We have some frameworks with which are monothematic, like the TCFD on climate, while others cover all ESG aspects, like SASB. So we also have some frameworks and standards that are very granular and specific, like GRI and SASB, and others are very high level and non-prescriptive, like TCFD. So globally, they are all high level, voluntary in nature, and non-binding. And I think that the diverse and voluntary nature of ESG-related frameworks may in turn reduce the reliability and the usefulness then of ESG-related disclosure by financial market participants. So the good news is that in September 2020, the 5 leading framework and standard settings announced to share a common vision for a comprehensive corporate reporting system. So we very much look for this, and I think that what we clearly need is an IFRS for sustainability data, which would really change a part of the world and help really investors to understand better and to be able to report.
So thank you. So there's some big developments here going on. Denise, in terms of these, what do you see as the next things that we have to do to make this work on this agenda? And I'm really conscious that while the European Union and China is moving on regulatory steps around a bunch of areas, many other countries still rely on fairly vague guidelines. Is this going to change in the regulatory environments in countries around the world, or will people just end up adopting European China rules? How's this going to work?
It's a great question. I think that what we'll see is, first and foremost, so when you when you look at the landscape right now, the globally most referenced framework for sustainable finance, I would say, would be the Green Bond Principles, and the suite, in fact, of the principles. And I think we worked very hard to keep it that way, to make sure that it is accessible and applicable to many, many jurisdictions. And at IFC, we continue to work with regulators through the Sustainable Banking Network, now renamed Sustainable Finance Network, of course, to assist regulators in bringing to the fore some of these guidelines that will be more applicable, bearing in mind the idiosyncrasies of some of these markets. Looking particularly at the emerging market, I mean, last year we saw 40 billion of issuance in the market, predominantly green. With 21% growth since 2019. I think the size of it's often compared with the developed markets. Well, it's only a sliver, and people fail to think about what that volume means. So 50 million in Rwanda is a huge deal compared to 50 million elsewhere. But I think we also need to look beyond that. What is it financing? And this comes again to, are they bankable projects? Bringing it back to policy, I think that what we will find, or what we also need to see, is that the policy, and now with the NDCs being updated, that we are seeing concrete ways to bring that into some of these discussions that we're having around strategies and bankable projects, etc. I'm quite keen on moving outside of the financial sector and going to where the real change needs to occur. And again, it brings us to the conversation of transition. So when you consider the real sector, and in most of this, let's take Africa as a very good example. I mean, the entire continent's output of energy is Spain's. So there's so much room for growth, but the opportunity to leapfrog, of course, as we know, 2% of the land area could provide solar for solar power for the entire continent. What we fail to see is this gap of how do we bring those conversations, then adding the layer of finance. And this is where, when you look at the conversations in the developed world around EVs, very good example, how the conversations have changed over the last few years and how policy can lead to, strategies and business models changing. Just looking at all the car manufacturers and who are the investors that are backing that? This is where, again, the products need to be accessible. And lastly, I would say the role of the infrastructure of the market cannot be understated. And this is where, of course, the transparency and reporting again comes in, and the stock exchanges. So it is an ecosystem, and it's very hard to take one apart and expect for it to go off on its own. But long story short, what I do expect to see is that there will be regional guidelines around certain sustainable finance issuance and what have you. But by and large, I think as the NDCs are being updated, I hope to see at a sovereign level more concrete connections from those plans and the SDG plans into how the budgets are being funded through financing. And we're working at the principles to ensure, of course, that sovereigns can and have used the principles as a framework for issuance.
Very cool. We've got to wrap up. I've just been realized the time. Alberto, you're a company in transition, to pick up Denise's terminology. Give us your predictions for how this market's going to go, but also tell us just give us a couple of teasers. How is Enel going to shift? Because you're a fossil fuel company historically, and Europe's emissions are going to be cut 50%, 55% by 2030, let alone global emissions. What are you doing in this role? What's it look like? Give us a flavor of those 2 points.
Well, so I would say it's easy. So we are fully working into the climate challenge. But what we have found within working in the climate challenge is that the only way to solve this situation is to fully decarbonize the production and fully electrify the final uses. When you do these two things, we have solved 80% of the problem. But so if you look at us, we produce energy. It is our product. So we are saying that to save the world, we have on one side to sell more of the product we do, and on the second, to produce it with technologies like renewables that today are producing energy at a lower cost versus the previous technology. So to cut a long story short, we have to do nothing. We have not to do any effort. It's so business as usual, and producing at lower cost and selling more on our products, but in a sustainable way. That is where the technology is driving us. That's why we think that at the end, we need for all the business to have some simple solution that are no way. So we decided it because there is another way to do it. It's the better way. So we have an incredible big market in front of us. Electrifying everything means 10 times the use of the product we sell in the next 20 years.
That is a very exciting way of looking at it, a vision for transition, if ever I heard one. We need every company in this space to be adopting that rhetoric. So thank you. Jaffa, your predictions, your thoughts about the future, looking 5 years ahead.
So my thoughts, I think COP26 and the global regulatory, meaning governments, are converging. There's no longer a big dissenter who's saying this is not true, right? So I'm seeing a few years from now, the resilience market to be the normal market, and the transition to have shifted into no longer we have to do this, into how we do this better, and how do we value the assets below that. Because I think what's not yet being discussed is this issue of the business model on the infrastructure side. How do we actually value nature, right? Because now we are starting to understand it has value. So those discussions, I think, are the future, and the value is definitely much, much bigger than where we are now.
Much, much bigger. Julie, that's good news for you and I. Your predictions on the future. Think 5 years ahead. Is the Luxembourg exchange going to be entirely green? What do you see?
Well, I think we are trying at least to go in that direction. But as Mark Harney said, I like it very much. He said, we need to move from a transition in thinking to transition in action. And that's really what I think that we will increasingly see over the next 5 years. And what is clear today is that it will be increasingly hard for companies that do not have a credible ESG profile and a clear sustainability strategy to access capital markets. So green, social, or sustainability side projects are not enough. They will be forced to change. And I think that market levels of all market participants on all levels of the value chain will increasingly apply sustainability requirements, be it stock exchanges, but also green underwriters. And stock exchanges clearly have a role to play by adapting their listing requirements to a more sustainable behaviors.
Very sharp perspective. All companies change. Denise, our last prediction. Take us forward.
So I've always said, I think the future, we've no choice. All finance needs to be sustainable finance. This is, we cannot have infinite growth in a finite planet. Everything that we do at the moment, and I think will remain the case for a while, is financed somehow. And so we need to change those models and ensure that the finance, then there would be no need to have this subset of 1% of the market or 2%. The strategies need to change, and that needs to be fueled, of course, and cannot happen without finance. So I do think that over the next 5 years, we will see, as Jaffa said, there will be even more of a convergence in terms of the issuer behavior and along the lines of ESG profiling because of the access to markets, just the way that you can't go to market now without thinking about credit. It will continue to be that way, plus the ESG credentials on top of that. And then lastly, I think the market, we will see that there will be even more push from a policy angle towards making this occur. From the investor side, what has worked has been keeping it simple. That is why the green and social bonds have worked, is because it's easy to understand, there's no additional risk. Of course, there are always niche markets that will continue to exist, but by and large, we're thinking scale. That is why there's the simplicity of those products. Now, of course, we have the sustainability-linked bonds, which are, of course, gaining hold. I hope to see that in time, there will be no need for new labels. As I say, there will be no need for that, but that there would be this accepted understanding and embedded expectation within every financing model that those 3 ESG credentials and standards are being upheld and looked at. And that's what I hope. So sustainable finance equals finance, this formula.
Fantastic. I mean, I think our listeners need to know we're essentially designing an electric car here. The work like the taxonomies, the work of regulations, all of the wiring under the hood. But of course, the intent and of course the success will depend on being able to get in the car, press a button and drive off, literally. It will be an electric car for a while, but soon it will be just a car because there will be no other choice. That is where we're going. I think that's the import of what Denise is saying. Thank you so much. Thank you, Alberto De Poli, the Chief Financial Officer of NL, a champion of this market. Thank you, Julie Becker, the CEO of the Luxembourg Stock Exchange and the founder of the Luxembourg Green Exchange, and I'm going to say a force of nature in sustainable finance circles in Europe. Thank you, Denise O'Donnell, Head of Investor Relations, the IFC, the organization that broke open this market, I have to say. And then, of course, Jaffa Makano, Global Program Manager for Municipal Investment Finance at the UNCDF, Capital Development Fund, trying to make things happen where they need to happen. Because remember, 70% of our CapEx in the next 30 years will be in emerging markets, creating a world that doesn't actually exist now, as Jaffa says, creating clean, green, resilient economies and societies and livelihoods for people. As the World Energy Outlook report said, this future will create an improved GDP, more jobs, and better outcomes than the trajectory we've been on for the last 30 years. The prize is within our reach, but we've still got to get there, unfortunately. A sustainable future is the